Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. In today's episode, we're going to be covering a variety of different topics. We're going to be looking at the bond market that has just been signaling red flags throughout the past few weeks. A lot of investors are concerned about this look here that could perhaps begin to look something like what was happening right here with the junk bond market absolutely collapsing back in 2007. So we're going to be talking about that and the impact it's going to have on the broader market, on the stock market, on the S&P 500 that of course has been in a fierce downtrend recently, scaring many investors, especially with the geopolitical uncertainty, with the inflation headwinds that are at play. A lot of things to be worried about here. We're going to be discussing all of that in this video. If you are interested in following these crazy markets with us, do not forget to smash that subscribe button because we make these videos multiple times a week covering everything that's happening around the world, geopolitical events, macroeconomics, and everything that can have an influence on the stock market and of course how to take advantage of it. Now, without further ado, let's get right into it. So let's start this off by taking a look at what I was discussing in the beginning of the video, and that is the high yield bond ETF. So in other words, the junk bond ETF. Now this is exactly what the name says it is. These are junk bonds that have a high risk of defaulting. Now they tend to have a higher yield, but they have a higher risk. And so when things go bad, economic conditions worsen, that's when junk bonds tend to fall. They tend to underperform as the risk of default increases. And so when you have this type of move in the junk bond market, you have to be paying attention to it because that's the market telling you that credit risk is increasing. Now, just to put this data into perspective, this is another way of looking at the high yield index. This is the spread between high yield bonds and treasury bonds. So here we can take a look at a longer term chart and you can see the rise that we've had here when you put it in proportion with other events that have occurred before, for example, the 2008 financial crisis. It doesn't look very bad here. So credit risk is rising in the short term, but it hasn't yet become a super concerning look like it was looking right here back in late 2007, right? Keep in mind here, let's focus in on 2007. Credit risk was rising ever since May 2007. It was steadily rising throughout 2007, but the markets didn't actually top till around October 2007. This is something to watch. This is something to monitor. And I do think that this is only going to get worse and that we're only going to see credit risk rising more and more. But in the very short term, this is just not the type of development that's going to trigger a massive bear market over the next month. In fact, if we take a look at the sentiment on J&K in the short term, it's extremely bearish. It's very bearish. We're all the way down here, and every time you get this type of move down here into extremities, it signals that you're getting close to a bottom here. You're getting close to a bottom. You can also take a look at the high yield bond advanced decline index, and you can see again, we're very extreme here, very oversold in the short term on the high yield bond. And every time that happens, it triggers some type of a short-term bottom here. This was COVID, where high yield bonds were extremely oversold. That triggered a bottom. It's not always perfect. In this region, it wasn't perfect, but it gives you an idea of the risk reward. So I'm not an expert in junk bonds. We're not basing a whole lot on this, but in the short term, it tells me that the panic we've seen recently may be slowly coming to an end. Maybe we get one more panic move down. That's entirely possible. We have some pretty strong levels of support just under here at $100. But this is a big risk-off move that some indicators are suggesting is slowly coming to an end. And if we see some of that fear come out of the market and we get a nice counter trend rally on the junk bond market, what would that mean for the S&P 500? Let me add the S&P on this chart, and you can see every time you get a bounce on junk bonds, every time it is correlated with a strong performance in equities. You can see without fail these bounces, and I'm not taking all of them, but all of them correspond to rallies in the S&P 500. So, again, we're not basing a whole lot on this, but if we get a bounce on junk bonds, which seems pretty likely here, we'll be getting a bounce on the S&P 500 as well. Now, I had another chart to show you guys, and this is the NAAIM Exposure Index. It's another survey that shows us the market sentiment, but this is more specific to actual investment managers, so active money managers. So as opposed to the retail investor who may make up a much smaller proportion of the market, this survey actually shows you how active money managers are positioned. If all money managers are positioned long, you don't want to be positioned long with them because you're staying in the market at their mercy and just hoping that they won't sell. Whereas if you step into the market when money managers are not in the market and are under positioned in the market, then you're betting on the fact that the only thing they can do is buy. They can't sell anymore. They're out of the market, so they can't push the price down. They can only buy. So that's the entire concept behind using sentiment indicators. If everyone's short, and that's what I want to talk about here, is this exposure index is showing some pretty low readings for the first time since COVID-19. And before that, it was right here in end of 2018 at this bottom. Now, again, it's not perfect. Look at this here. We had a small spike down. Markets made a temporary bottom, but they eventually undercut that bottom and went on one more final sell-off before really bottoming. Is that possible? Yes. Is that the scenario that I'm betting on right now? No. I don't think that we're going to go lower than these lows here. Anything is possible in the markets, right? If you don't know that by now, then you have a lot to learn. I think the sentiment has just been so unbelievably bearish throughout the past few months. Everyone's talking about a crash. Everyone's talking about a bear market, about the tightening, about inflation. I think a lot of these problems have been discounted by the market. We've worked through them in this consolidation, and as soon as things start to get a little bit better, you're going to start to see the markets rally, and all that narrative, all that negative narrative is going to change. And you're going to start to hear, oh, everything is great, the economy is booming, the stock market is booming, we're going into a massive 20-year bull run here. That's just how market psychology works. But if we want to stay objective on here, so I think we've seen the bottom here and we're ready for another run higher on the S&P 500. But we are definitely getting in the later part of the economic boom, and especially of the stock market boom. This is the yield curve, and we're approaching dangerously close to recession territory, where you can start to look for a longer term top on the equity markets. In fact, if we take a look at the equity markets priced in gold, we've already seen a significant top here. We've been talking about that on our website for months now, that the Dow to gold ratio was at resistance. Now, a rejection doesn't mean that we're entering a bear market just yet. There's been plenty of times where you get a rejection and then the markets still make new all-time highs. And I think we're still in that part of the cycle here, although again, nothing is 100%. But what this means here is that gold has likely started the next part of its massive bull run. And that's exactly why precious metals are a big part of the research and analysis that we post on our website. We've posted many videos, many articles talking about gold being a hedge against an overextended financial system, that it's extremely oversold relative to the money supply. And if you jump over to the investing tab, we have our entire bullish case for gold over the long term highlighted on there. And it's not just because of Ukraine or the potential for war to come out. That's been a catalyst, but the underlying macro has been there all along. Now, I do think we'll see more opportunities to grab some gold. I do think we've seen the bottom here and that this is a massive breakout, possibly to the all-time high before we see any type of consolidation. But we'll be looking at this opportunity very closely over the next few years. If you're interested in doing that with us, make sure to click on the link in the description below. There is a free trial. We really try to give access to our service as easily as possible. There's a lot of services out there that try to scam people into purchasing their service before the client can actually see something. So make sure to check it out. Go check the articles that we have on there. We have a huge amount of positive feedback on the things we post. So I'm positive that you guys will like it. Now that's about all I wanted to cover in this episode. If you guys enjoyed, make sure to smash that like button as hard as you can. Now, in the meantime, I wish you good luck on your trading and see you next time.